S&P Global Ratings has lifted its forecast for India's GDP growth to 6.5% for the current fiscal year, FY26 ending March 2026, up from its earlier estimate of 6.3%. The revision is driven by the expectation of a normal monsoon, softening global crude prices, and monetary easing, aligning with the Reserve Bank of India's own projection of 6.5%. This upbeat outlook highlights India's underlying economic resilience in the face of global fragility. Despite mounting global headwinds, including geopolitical unrest in the Middle East and a surge in US tariffs, S&P underscores that strong domestic demand, supported by income tax relief measures and anticipated rate cuts, will keep growth buoyant. A normal rainfall season is seen as key to bolstering rural incomes and consumption. A decline in global oil prices further reduces inflationary pressure and augurs well for the current account. However, S&P also cautions that persistent high oil prices or renewed geopolitical tensions, especially involving the Middle East, could dampen momentum. Policymakers will need to manage external risks, including US trade policies and volatile commodity markets, while maintaining growth support. The outlook echoes similar optimism from India's CEA, who described the country as a bright spot in a dark world, and projections from ICRA and the RBI, which also expect GDP growth to remain near 6.5%. After expanding at 7.4% in Q4 FY25 and maintaining a 6.5% pace for the full year, India stands among the fastest-growing major economies, supported by strong consumption, public investment, and sectoral revival. In summary, despite external volatility, India's internal growth engines, rural recovery, policy support, and consumer demand are keeping the economy on track. With a stable monsoon and lower oil costs, India is poised for continued robust expansion, though heightened vigilance is required against external shocks that could potentially reverse gains.